United Technologies and Raytheon. This is the video you all have been waiting for. You guys know that I own United Technologies, ticker symbol UTX. It's my number 4 favorite dividend stock of all time. I love this company. A lot of change happening with this company. Even before this proposed merger between Raytheon and United Technologies, United Tech was already doing a lot. They're splitting into 3 different companies, one for aerospace, one for elevators for Otis, and one for HVAC for Carrier. And so they're already splitting this company apart. They already acquired Collins Aerospace recently, and now they're saying that they're going to take the aerospace company, the one that has Pratt & Whitney and Collins Aerospace, and merge it with Raytheon in this huge mega merger. There is so much happening with this company, and so I wanted to take some time today to discuss what's happening and how I look at it from an investor standpoint with a really long time horizon, from a dividend investing standpoint, and how I'm going to treat this in my personal dividend stock portfolio. So let's get started with today's dividend investing video. All right, everyone, so I thought I'd just start with some facts, just with some background on what the heck is happening here. And so, as you guys know, UTX, United Technologies, that's the ticker that it trades under. It actually is splitting into 3 companies. One is going to be UTC, and again, this is the aerospace one that has Pratt & Whitney and Collins Aerospace. Collins Aerospace was a recent acquisition of this company. They've got Otis, that's going to be a completely different company, and they've got Carrier, that's going to be a completely different company. And as you know, if you've been watching my videos for a long time, and I will link to them in the description below, this has been my number 4 favorite stock of all time. I personally liked the stock best when it was like this, kind of in the old format, where it had aerospace, it had elevators, and it had HVAC. I kind of liked that industrial conglomerate nature of it. That was something that was appealing to me when it comes to this company. But I said, you know what? To heck with it. When this splits into 3 separate companies, I'm just going to kind of manage those 3 companies as if it's the same one stock as before, and all 3 of them will kind of line up and take my number 4 favorite stock in the portfolio. But now with this Raytheon thing, there's just so much changing. It's all in flux, and so my plans might change a little bit. I'm going to get to that a little bit later, but first I want to talk about what's going on with Raytheon. And so anyways, UTC's got Pratt & Whitney and Collins Aerospace, and they're going to merge with Raytheon and become Raytheon Technologies. That's going to be the name of the new company. And Raytheon, they're really good with missiles, they're really good with radar systems, whereas UTC, they're really good with engines, with jet engines. And so it's an interesting merger because from what I understand, from what I've read, there's not a lot of overlap between the 2 companies at all. There's they're doing kind of different things. They're in the same space. But I think the value proposition of this merger is just creating basically the 2nd largest aerospace / defense company out there behind Boeing. And so there's a lot of promise to this acquisition, but it's an interesting one because there isn't a lot of overlap. It's really creating a unique new company in this aerospace landscape. Anyways, one thing that got me interested right off the bat is that they've already stated, I think I read this in a New York Times article, that within the first 3 years post-merger, if the merger does go through, the combined company is going to return $20 billion to shareholders through stock buybacks and dividends. Stock buybacks I'm not as interested in. Dividends, as you know, I plan to live off of dividends. I love dividends. This channel is all about dividends. This is YouTube's dividend investing channel. We are over 28,000 subscribers strong. I love dividends, and so it was nice to hear that. That said, I don't like buybacks quite as much, and so it was nice to hear, though, that they're going to be shareholder-focused. As I would guess, they're going to continue the legacies that have been set forth at both companies and continue to reward shareholders with dividends. And so that's really nice. And you'll see more in a minute how both companies have been really solid dividend growth stocks. Now, UTC shareholders are going to get 57% of the combined company, and then the remaining 43 is going to go to Raytheon shareholders. And so this is going to be an all-stock merger, and so there's going to be no additional debt taken out either, which is just a unique spin, unique dynamic as to what's happening with this merger. And so the way I look at it is, look, when after UTX splits into 3 companies, which it should sometime early next year perhaps. Once that happens, should this Raytheon merger go through, it gets approved by everyone that needs to approve it. Basically what will happen is my UTC shares will just convert basically over into Raytheon Technologies shares in the combined company, and I'll own it on a 57% kind of ratio of the combined entity. And so that's how I expect things to go down. Now, activist investors don't like it. So Bill Ackman is one that just spoke up. And it was interesting. Bill actually said that he doesn't like what's happening. And I'm not quoting him word for word here, but I read something that he said he will oppose this merger of equals, and if he has to, he will do so publicly. And so I was kind of excited to see all these activists opposing it, because what's funny is a lot of these activists, they're invested in United Technologies. They actually pushed for United Technologies to split into 3 companies, which they're doing. But this Raytheon thing kind of caught them off guard. And what happens with whenever you kind of split a company up into several companies, it kind of unlocks value. It unlocks short-term value. When that happens, they kind of, at least from what I expect, what I've seen in the past, they should kind of, the sum of the 3 should be worth more than the combined entity. Now, as a dividend investor, I don't really care because I'm only investing for dividends. I personally wish it was just the combined entity, just leave it alone, let it do its thing. But anyways, activists were pushing for it to split up because they're all focused on the short run. Now, this Raytheon thing comes along. They hate it. The reason they hate it is, again, these guys are short term. They don't care about the long term. And typically when you have a big mega merger of equals like this, stocks go down. And so what's happening is United Tech is going down, Raytheon's going down. I personally love this because this could create a nice buying opportunity for someone like myself who is looking at this from a long-term perspective. But the activists, they're stepping up, they're speaking up, saying that they hate this. And it makes sense that they hate it because they are focused on the short term, and anything like this causes stock prices in the short term to go down. And they don't care so much about dividends, they care about the stock price, capital appreciation. So that's why they're opposing it. I don't think they're, at least that's my 2 cents, I don't think they're opposing it for any other reason than they have their own financial interests at heart, and their financial interests are shorter term in nature. At least they tend to be in this whole hedge fund activist investor scene. Anyways, President Trump, he's concerned about this as well. He spoke up and said that he's concerned it could reduce a little bit of competition and innovation. And so being in the defense space, especially Raytheon being heavy in defense, it's important that there's enough competition between companies. It's important that there's enough innovation happening because it takes our defense to the next level, and that's important, and it's something that the president is going to be concerned with, that the Pentagon is going to be concerned with, that a variety of people are going to be concerned with, regulatory bodies. And so one of the things actually I was reading is in the late 90s, Lockheed Martin, they were going to acquire Northrop Grumman, and that whole acquisition was actually turned down, it seems, by the Pentagon because they were concerned, again, that this would stifle innovation, that it would stifle defense innovation. And so, again, this is something that may come up. Something off the bat, quite frankly, one of my subscribers was asking me, Ian, you know, pick up some Raytheon shares. I am not, because quite frankly, I don't want more positions in my portfolio, and I don't even know if this thing will go through. Maybe it will not happen. Maybe it will be like Lockheed and Northrop. Maybe it will just not happen. And if it doesn't happen, I don't want to be stuck with 2 stocks now. And so the only way I will play this acquisition or this merger of equals, and we'll get more to this later, will be through buying additional shares of United Tech stock. That's how I'm going to play it, because if it does not happen, at least then I'm just keeping with what I already have, which is United Tech. I already own 40 positions in my stock portfolio. I will link in the description below. You can download my dividend stock portfolio if you'd like, and you'll see United Tech, my number 4 favorite stock of all time. Anyways, let's just talk about the sales breakdown. This was interesting. So United Technologies and Raytheon, they've already created a website that explains what's going on with the merger, talks about the combined entity, and I thought this was really helpful. And one of the things it talks about are sales. So Pratt & Whitney, the big jet engine division at UTC, does 21 billion sales. Collins Aerospace does 22 billion sales. Collins is the aerospace company that UTX just acquired, and that's now part of the UTC division. When UTX splits into 3 companies, Collins, Pratt, Whitney, they'll be together in the UTC, the aerospace company. This is from UTX. From Raytheon, the intelligence, space, and airborne division does 18 billion in sales, or will be doing 18 billion in sales in the combined entity, and the integrated defense and missile systems will be doing 16 billion. So you see here that this kind of is a merger of equals. Yeah, UTX or the UTC component's a little bit bigger, but more or less Raytheon plus United Tech, you're kind of doubling the size of the company, and so it's a interesting fit, and I think it creates a conglomerate, if you will, within this defense aerospace segment that spans 4 categories, big categories now, instead of just 2 on each side. So I thought that was an interesting take on this, creates some diversification. Now, before I get any further, I do want to point out historically, and one thing that's just been going through my mind, I don't have defense. I don't have a defense company in my portfolio. Historically, I have not had a defense company in my portfolio for 2 reasons. Reason 1 is defense is very tied to the US government spending. I tend to not like being tied to the government so much for all of my revenue, because the government really may decide one year to spend more money than the last year, but then in the future they may spend less. It's a lack of diversification, if you will. It's a complete lack of diversification when you have one customer. Now, the other thing, quite frankly, is being tied to the U.S. government. There is a political risk. Right now, the presidency is very pro-defense, and it's a very good thing for the defense industry, the Trump presidency. Now, if that were to change in the future, if the presidency maybe swung back at some point more liberal, the next president, or that future hypothetical president, may not want to invest so much in defense. And so that's something that's always scared me about defense, and that's why I haven't gone for any pure play defense companies like a Lockheed Martin, for example, and why I've actually skewed more towards United Tech, because United Tech, one, historically it's been diversified. It had Otis and Carrier as well, but even within UTC, it is more focused on commercial than on military, than on defense. Whereas Raytheon, it is all about defense. And so, anyways, that's the background on why I really haven't had a defense stock. That's point 1. Point 2, quite frankly, is I don't know how I really feel about investing in a defense company like this, just from a philosophical standpoint. I'm not saying I'm against it, but I'm not saying it's something that I run towards as well as an investor. I just don't know. I'm not saying I've even formulated a strong feeling one way or another, but just from a philosophical standpoint, I just have not really found out where I stand when it comes to defense companies, and so I've always kind of just not included them in my portfolio because I have so much diversification in so many other industries like utilities and healthcare and consumer non-cyclical and SIN stocks and master limited partnerships, all kinds of stuff, restaurants, and so real estate investment trusts, and so having defense in there, it's just never been a priority to me. But at the same time, this all intrigues me because it is interesting. It's like, hey, Ian, you're finally going to get that defense exposure. And so I'm not against it. I'm still trying to figure out what to make of all of this. But anyways, that's just some philosophical stuff that I've been thinking about over the years as it pertains to defense. So I want to dig into some numbers now. So I have two columns here, United Tech and Raytheon. First and foremost, price per share doesn't really matter, but it affects some of the metrics below. United Tech is at $122.94. Raytheon, $177.62. Mind you, both share prices are going down after the announcement of this merger. Really good thing. For a long-term investor like myself, who does not care about short-term capital appreciation, I only care about dividends and living off of dividends, using dividends to pay bills. And so lower share prices, good thing, I'm buying more value. So the 2019 EPS estimated, the consensus estimate from analysts, $7.98 for UTX, $11.64 for Raytheon. And so if I take the price per share, I divide by that consensus estimate for each company, I get the PE ratio, the forward 2019 PE ratio. Both of them are 15s. UTX 15.4, Raytheon 15.3. So I circle these numbers because both of the companies right now, in my humble opinion, are reasonable values. They're not deep discounts. They're not screaming buys. But I even did a video about this a few months ago when I was setting up the scene. Ian, what are you buying in 2019? What are you buying right now? One of my strategic focuses this year was United Tech, and one of the reasons is it was trading at a reasonable PE, and I continue to believe both of these companies are at reasonable PEs. And so going forward this year, will I continue to buy more United Tech? Yes, I will. I will do it regardless of whether this merger goes through or not, just because it's at a reasonable PE. It's my number 4 favorite stock. It hasn't even split into these 3 companies yet. And so the way I look at it is I'm paying a 15 PE for the UTC, for the aerospace component. I'm paying it for Otis, and I'm paying it for Carrier. So I'm getting into these 3 companies at a PE of 15. Yeah, I'm willing to do that, and I hope it trends down more. And so if you're a Raytheon shareholder, though, also worth noting, 15 PE there as well. So liabilities, this is one thing that's interesting. I was just looking at the balance sheets. Long-term liabilities for UTC or UTX are much higher than Raytheon. So it is $62 billion. Raytheon has only $11 billion. So I circled long-term liabilities for UTX. UTX has racked up a lot of debt. I believe part of that is likely due to the Collins Aerospace acquisition, if I had to guess. But it's something to point out here that actually when I was looking at both companies, in recent years at least, Raytheon in many ways is a stronger company from a performance, financial performance perspective, a balance sheet perspective. And so going into this, I already own UTX. I love it. It's a great company. And so if I see them merging with someone else, I want to know if the company they're merging with, are they a good company? One of these activist investors was saying Raytheon's an inferior company. I think they're saying that again because they're focused on the short term. They don't like the stocks going down, which always happens with this kind of merger. It's just a fact of the uncertainty that's out there in the marketplace right now. But when I look at Raytheon, quite frankly, I don't look at it as inferior. It may, in fact, in some ways be superior to UTX, and so I liked that. I liked that it was carrying less debt, that it had a really clean balance sheet, and in fact that its revenue growth, its cash flow growth, it actually showing some nice cash flow growth where I'm not even seeing that at UTX. And so again, nothing wrong with Raytheon. In fact, in many ways, I really liked how that company was performing. I thought it was really great. So moving on, the dividend, 2.4% dividend yield on current dividend yield for UTX, 2.1 for Raytheon. Both are lower dividend percentage companies, but that means they have lower payout ratios as well, more room to grow the dividends at both companies and at the eventual combined company should the merger go through. So the compound annual growth rate of the dividend at UTX over the last 5 years has been a 4.5%. So on average, they're raising the dividend 4.5% per year. I'd like to see it a little higher, especially given the really low dividend yield and lower payout ratio. And at Raytheon, it's been a 9.3%. So again, I was really excited to see that. I like that Raytheon has that history of the higher dividend growth rate on average per year. And so perhaps the combined company, it may work out better for UTX shareholders. It may be that the dividend growth rate accelerates a bit. Now, the reason the UTX dividend growth rate has been a little sluggish, a little lower, quite frankly, is probably because of the liabilities and probably because the company wants to take some of that excess cash flow to pay down debt over time. And so Raytheon does not carry that kind of debt, and so they have the liberty to raise the dividend a little more aggressively. That being said, what was interesting about Raytheon is the fact that they're raising it this quickly. It speaks to their confidence about the future prospects of the company, which kind of dispels some of my concerns about volatility in defense spending going forward. And so that was just another way to say, I don't think Raytheon is so concerned about defense spending being curtailed, because otherwise they wouldn't keep raising the dividend. It just wouldn't be a prudent thing for the board of directors to approve. And so when I look at the two companies side by side, they are so similar in so many ways, but I would say the main difference is that UTX is a little bit plagued by the higher debt load, but at the same time, the legacy UTX, it's a really big company, much larger than Raytheon when I look at UTX, because that still includes Carrier and Otis, and they made that big Collins Aerospace acquisition. So just interesting things to note. So looking over here, this is the one thing I like about UTX, and I think is worth a premium at UTX. Commercial industrial is 47% of the company. So that's basically Otis and Carrier, I believe. Military aerospace is only 14%. Commercial aerospace is 39%. So basically, if I take the commercial industrial out of the pie, that goes out of the pie because that's Otis and Carrier, and I look what's left. I'm just assuming this is more or less 50-50 here. The commercial aerospace side of things is 39%, but I double that, it becomes 78%. Roughly 78% of UTC is commercial, and then so the other 22% would be military. This is really important. Historically, I felt really good about this, and I felt good about this because I tend to believe that commercial, it's a lot more diversified than military, where your customer is usually going to be the US government and then some foreign governments, but it's not quite as diversified. It's really reliant on US government, and so that's something that UTX and its subsidiary UTC have going for it really strong. By contrast, Raytheon, US government is 68% of their sales right now. US commercial is only 2%. Foreign military is 13%. Foreign commercial 17%. So Raytheon is really, really focused on military, on US government. And so I don't like that as much. Now, that's why as a pure play, again, I just don't get so excited about defense companies, and maybe I've missed some really good opportunities because these companies have done really, really well. I know Lockheed Martin, for example, has done really, really well. Now, that being said, I've always preferred my strategy with UTX. Now, with the combined company, it's going to have that huge commercial exposure, but it's also going to have the huge defense exposure. It's going to be a little more diversified. From what I have studied, it actually just so happens that both defense spending and commercial aircraft spending are cyclical, but oftentimes the cycles are different. They're not at the same time. The cycles will peak and trough at different times, and so they can counterbalance each other. And a living example of this is Boeing. And so some analyst I was reading, or new article I was reading online, cited Boeing, that because they have those two cyclical businesses, but they kind of balance each other, it helps smooth the numbers up and to the right over time. And so I hope that's right, because that would be a good thing for this combined company, and it could be a reason for it to be a combined company, because we're kind of headed right now, in my opinion, towards the top of the market, top of this economic recovery, and there's going to be a recession at some point. And so oftentimes, another analyst was mentioning, or economist was mentioning, there's a lot of mergers happening now because that tends to happen before a recession, because these companies are starting to prepare, and they know that if they take out a competitor, they just combine with a competitor, there's less competition. It makes it easier for the company when the recession hits. And so anyways, it may just be that with some recession on the future, having this combined company, it may be what's best for shareholders of both companies, and it may be that they're both cyclical, but they're on different cycles that they counterbalance each other out. So anyways, that's what my due diligence has shown me so far. I historically have not known much about Raytheon, now I do. And I look at this, what am I going to do? How am I going to look at this thing for my own portfolio? Look, this is my number 4 dividend stock of all time. I was going to treat it as 3 separate companies. I don't really see anything changing for me here. If it doesn't go through, fine. If it does go through, great. And what I'm going to do literally is when things go forward, I will just treat these 3 stocks as one, and they'll probably be more or less combined as still my number 4 position. Now, it may change over time. I mean, as I get more comfortable with another company I own, 3M, for example, I'm allocating a lot of effort in building my 3M position this year. And it may be over time, I want to kind of have that industrial exposure as my number 4 favorite stock. 3M, I put it at my number 10, and I only did that because I just started buying it in 2018, and I wanted to become more familiar with the company before rating it too highly in the portfolio. I don't know at some point if UTX, the three companies are going to kind of come down in my top 10, and 3M is going to rise through the ranks. I could see something like that happening. But right now, in the short run, this Raytheon thing, I'm not really super excited about it, but I'm also not super down about it either. I see pros and cons, but it doesn't really change my strategy. From a dividend standpoint, I certainly believe the combined company will continue to pay a dividend. They will continue to raise the dividend, and quite frankly, the dividend growth may be better than what I was seeing before with UTX. Raytheon's had a stronger dividend growth, and I will just watch what happens at Raytheon Technologies, at Otis, and at Carrier, and I want to see that the dividends for all of them are growing. And if their dividends are not growing quickly, if the new companies in one way or another take on a different policy that's different than what I'm expecting, certainly at that point I will reevaluate what I'm doing. But right now, because there's so much uncertainty out there, I'm consciously taking on risk, and I'm consciously taking on risk by buying UTX. I bought some UTX quite a bit, quite frankly, earlier this year. Lately, not as much. It's actually trended up a bit since when I bought it. I'd like to see this thing fall more. I hope it does. If it continues to plummet, I will probably dip in and buy some more UTX. I'm happy to buy at a forward 15 PE ratio. I really like that multiple. I think it's a not deep discount, but it's a good bargain. It's a good bargain in this market. And if the forward PE gets down to like a 14, for example, that's going to be a really solid bargain for this type of company. And so I'll just continue to buy. But I know some investors on Twitter. I have a lot of followers on Twitter. Love you guys. Thank you. The subscriptions, the follows, the likes, the thumbs up, all the support in social media. It means the world to me. It's the greatest way you can thank me. I love you guys. I know a follower on Twitter was saying, "Hey Ian, I'm kind of concerned. I want you to comment on this right away." And so I just want to let you know, at least from my perspective, I'm not concerned. There's a lot going on here. I guess that's what I would leave you with. And this is why I kind of question, is it going to be my number 4? I don't know if this will continue to always be my number 4. I'm treating it as that at this time. But typically with dividend investing, one of my golden rules is I just kind of invest in the predictable. And the predictable means not too much change. Like, yeah, 3M, they acquired some company a few months ago, big acquisition for them. But in the scheme of things, that's not going to really change the face of 3M going forward. This stuff, this is earth-shattering. This is taking UTX and completely turning it inside out. It's splitting it into all these companies, merging with Raytheon. It's a lot of change. And so I'm saying, as a dividend investor, typically I invest in the predictable. I invest in stuff where not too much change is happening. I like stuff that's growing, where it's showing organic growth. But when there's a lot of change in the form of mergers and acquisitions, it can create something that is completely different than what I invested in to begin with. And so I guess that's the thesis I will continue to challenge going forward. Is this what I wanted? Is this what I originally intended? If it's not, I can always change course, but I'll tell you, my radar at this point tells me that all of this stuff continues to be treated somewhere in the top 10. As a combined entity, when I combine the 3 stocks I'll be owning, somewhere it falls in the top 10. Now, it may fall to the 10th position, and 3M may go to the 4th, but look, it's going to be somewhere in that top 10. Even with everything that I know here, all of this change, it's a lot of change, but it's a lot of change on only one position. That's another takeaway for you. This is why diversify. If this is the only company I own, this is just too much change, too much uncertainty. I'm trying to live off of dividends. I need some predictability with my dividends. And so anyways, that's how I'm looking at it for my own portfolio at this time. I know I didn't give a very clear answer on that other than I'm going to be buying more UTX this year, most likely. I'm going to treat it as my number 4 still, but it may get kind of moved around, reshuffled in my top 10 somewhere, but it's going to stay in that top 10. Would love to hear what you think about this Raytheon Technologies company, the proposed new company between UTC and Raytheon. It'll be real interesting to see what everyone in the community thinks. Please put your comments below. Let's have a thriving discussion. We have such a beautiful community here of dividend investors. Everyone's sharing all of their ideas, their insights. We are 28,000 dividend investors strong. All right, everyone, it's kind of late at night, a long day again. Enjoying the summer weather, though. It's heating up here in the Bay Area and real hot, quite frankly. And so before I leave today, in terms of a full disclosure, I own the companies, 2 of the companies mentioned today. I am long United Technologies, ticker symbol UTX, and also 3M, ticker symbol MMM. In terms of a disclaimer, friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Literally just sharing my journey here on YouTube for fun and entertainment. Thank you so much for watching the videos. If you want to thank me for this video, please subscribe, comment, like. It all means the world to me. The social media support does as well. I'm on Twitter and Instagram. I'll link in the description below where you can find me there. I will see you in the next dividend investing video.